Hey, that's a pretty exciting little opening there. It's got a little jazz to it. I can't wait to see if Art likes that. That's a little different than a 30-second countdown. Speaking of countdowns, this is the first week in a row for a while that we have almost nothing but good news today. You know, a lot of times when certain people, and I won't blow any surprises, but certain people meet, it's usually doom and gloom. But today, it's all good news, and I can't wait to bring on the one who's running this three-ring circus today. That is your host and expert in the mortgage industry. That is Art Alvarez with MortgageWorks. Art, welcome today.
Hi, Jeff. How are you?
Good. You know, it was so exciting because you've got me so dialed into checking that 10-year all the time. I felt like that's part of my morning ritual at 4:30 in the morning. Like, okay, where's the rate? And there's some good news I know you're going to share with us today. So I'm excited to have today's show and a lot of good things going on today.
Yeah, absolutely. But in particular, rates. This week has turned out to be really good rate-wise. I think some relief that everybody's been looking for. Now, of course, that doesn't mean we're back to like 6 or 5, but I think the trend has reversed, and I think it may do so for an extended period. So.
Well, it seems like when things are going up or down, and no matter what direction, up or down, people are wondering, well, let's wait till it stabilizes to jump in. It's almost like catching a falling knife, right? It's like, hey, let me wait till it actually lands and then I'll grab it. And It seems like now there's some stability.
Yeah, it seems to be, and in particular, given the not just the data points that came out this week, but of course the Fed had a meeting this week, which always gets the market's attention. And the results of that, I think, are proving to be some pretty good news for interest rates going forward.
Well, I'll let you dive into this. Before I jump off, I want to mention to everybody, if you're watching this show live or later, and you have a question or comment for Art, please put it in the comments, whether it's YouTube or Facebook, and he will jump in there and answer those questions. If it is live, of course, I'll be manning the comment section in the back, and we'll get your question on and get it answered. With that, I'm going to turn over to Art. Art, have a great show.
Okay, thanks, Jeff. Welcome, everyone, to this week's Mortgage Minute by MortgageWorks. My name is Art Alvarez with MortgageWorks, where we do have the answers and they're on the house. So I want to jump right into things because, as you know, we always start with a rate update and a market update in terms of the bond market. Here's our current rate grid. I've updated it today to reflect some improvement in mortgage rates. We've actually gotten a decent amount of improvement. In general, when you look at these rates on the grid, we're about 0.25% or more better than where we were a week ago. And this can be sort of underscored when Jeff pulls up the chart, the 5-day chart for the 10-year bond yield, which, as you know, if you've been watching the show, that's my favorite barometer or benchmark to check on every day to kind of get a trend of where mortgage rates are going. And this is the kind of graph we like to see. You can see a week ago, last Friday, the 10-year yield was basically approaching 490. Earlier this week, like on Wednesday, it actually got up, pretty good above 490. But then you see that big drop off going into today, and of course down to 4.66. So that's really good news. And as a consequence, mortgage rates have followed in a similar fashion downward in the same direction. And that's why I say mortgage rates in general, depending on the product, are about 0.25, even 3/8 better than where they were a week ago. So that's good news. And in terms of the details of why this kind of movement has happened, there's a few things. Number one, this week was a very crowded week for economic calendar data points, in particular from mid to end of week. Some of the items coming up this week included the Fed met this week, the Federal Reserve Board, ISM Manufacturing, that's Institute of Supply Manufacturing, Institute of Supply Management Manufacturing Index. And then, of course, there's JOLT, job opening labor turnover, and then employment numbers. Now, there's even more data points that are being released this week, but these are kind of the major ones. For the JOLT report, for example, last month, for the forecast for October was 9.4 million job openings. Actually, the actual number came out at 9.6. So that's an indication that businesses are hiring, which tends to be a data point that's showing some strengthening of the economy. Of course, there's ADP, which I've told you before, I don't like ADP in terms of their forecast of new job openings. There's initial claims for unemployment and the unemployment rate, which actually comes out on Friday. In terms of the initial claims for unemployment, that comes out on Friday too, and it's forecast to increase to about 217,000 from 210,000 last week. So if that were to be true, that would be a kind of a cross current of showing maybe the economy is weakening a little bit. ISM manufacturing was forecast to be 49.2, up from 49 in September, but in reality, it dropped to about 46.7. That's a sign of weakening. So again, we've got some cross currents here. But the big change in the market that's really affected the bond market in a positive fashion, as well as mortgage rates, is the Fed decision on the Fed funds rate this week. They had their meeting this week, concluded yesterday. And then, of course, after the meeting, the Fed has their press conference where Chairman Powell discusses the outcome of their meeting and their decision. Their decision was to leave the Fed funds rate unchanged. So the pause continues. And as a consequence, and further, while Powell did indicate there's still possibilities of increases on the table in the future, what's happening now is the financial markets, the bond market, they're reading into this that it looks very, very likely that the Fed may pause here and not go any higher. So that's really given some positive news to the markets. The stock market's way up today. And then, of course, you saw the bond yields coming down quite a bit from where they were earlier this week and certainly last week when we were teasing at the 5% level. So, cautiously good news. Hopefully this is going to maintain itself. I think it's going to. There's less and less signs that the Fed's going to keep raising rates. I think the effect of raising rates has already taken into effect just because of market rates in general, particularly in the housing market, already being at those elevated levels. I think that's accomplishing what the Fed was trying to accomplish. So with that, we'll go ahead and move into our next subject. And what I'm doing this week is I'm moving our schedule, if you will, a little differently. Normally, we will talk about last week's closing question at the end of the program. And this week, I wanted to move it up. And because it's going to be relevant to our next session on Q&A that'll come up in a minute. And just to repeat the closing question from last week, here it is. Last week, you mentioned a mortgage price, which is what a habit I tend to use. I tend to refer to mortgage rates as a mortgage price. And the question is, isn't getting a mortgage all about rate? What does the term mortgage price mean? Well, I want to go ahead and explain that and get into some detail because it can be somewhat of a confusing subject, but at the same time, I think it'll give you a better grasp of how mortgage rates are offered and what your options are if you're getting a mortgage. Now, I would say that the price of a mortgage includes the interest rate plus the what we call discount. Now, what discount means is you can have discount points, what that means is there's going to be some points or money charged up front to get a corresponding lower rate. Your next choice, which is the most common these days and has been, really for several years now, is to look for the best or lowest rate with no points. And then the third option is looking to get a rate, the best rate you can with no points, but maybe also to get a rate that's a little bit higher than market in order to get a lender credit in addition to not paying points. So on this rate grid that we have here that Jeff put together, I'm showing you, and I pulled this up a couple of days ago, and I'm showing you a rate range from 7 to 8% on the left side of the grid. Next to that is the APR. I'm doing that because, of course, I'm sharing interest rates with a general public on this program. So it is required that we give you an APR to go with these rates that you're seeing on the left column. Now, the discount column, that's the most important one in order to establish or to illustrate to you how there could be points, no points, or no points and a lender credit for a particular rate chosen. When you look at this grid, I would suggest that the market rate, the rate where the market is demanding a yield, is right around in the middle there, about 7.5%. You can see the discount price is 100.125. Well, what that actually means is at that rate, which was 7.5, and if we had locked it a couple of days ago when I put this together, the price or the discount price would have been no points, and the borrower would have gotten a rebate of 1/8% of the loan amount. And that's what you see on the right column all the way to the right. That column is points/rebate. So the market rate on this grid at the time I put it together was about 7.5. Now, understand that when you lock in a rate, let's say you did have a borrower lock in that 7.5 rate. In reality, on the day that rate lock is executed, that borrower actually has a choice of any of these rate and discount cost combinations on the grid. In other words, if they locked at 7.5 for 30 days at a price of 100.125, that's no points, plus they're getting a small 1/8% rebate from the lender. Well, let's say they're into their purchase escrow and they end up negotiating a deal with the seller to offer some credit that can be used to buy down the rate. Well, then, because we already locked the rate at 7.5, we could then revise the rate lock to the lower rate, let's say all the way down to 7. What happens there is you're now going to see that the price is no longer going to be 100.125. It's going to drop to 98.25. Well, that's a bond price. What that means is to get that 7% rate, there will have to be 1.75 points charged for that rate. And remember, a point is a 1% of the loan amount. So in this case, 1.75% of the loan amount, or 1.75 points, that would be the charge for that 7% rate. And as I've always argued, if you were going to do that, you're best served to get that cost, that 1.75 point cost for the lower rate, that buy down rate, get that paid for by the seller. Now, in some cases, what we'll run into is a borrower who's, good on income, their debt ratio is fine, but they're challenged on down payment. They're unable to negotiate a seller credit to either buy down the rate or to pay closing costs. So sometimes what they'll do, or they'll ask us, can we finance the closing costs somehow so we're not paying them out of pocket? Well, that is possible, and that's the other part of this grid. If you've already locked at 7.5, but let's say you decide you want to reduce your actual net cash closing costs, then what you can do is revise the rate lock and take a higher rate. For example, let's say you took the 7 7/8 rate. Well, if you took that rate, not only are you still not paying any points, you're now getting a rebate from the lender of 1.125% of your loan amount. Why is that? Because the 7 7/8 rate is above the current market rate by 0.3%. So if you're willing to close the loan with the lender at that higher rate, even after the originator is compensated, you've got leftover funds that you, the borrower, essentially own, and you can apply that towards your other third-party fee-based closing costs like escrow fees, title fees, appraisal fees, credit report, et cetera, et cetera. So this is a good example of how when you lock in a rate, you're not really locking in one specific rate, but you're locking in a combination of different rates and discount, either points or no points, or a net lender premium if you're locking in or changing your rate lock to a higher rate because you want to get those dollars and apply them toward other closing costs. So this is what I mean when I say a mortgage price. Just understand that when you're locking a rate, there is no one rate. You're actually locking in this entire grid. And in some cases, you may need to move the rate that you locked in at for the reasons I just described. And this would give you this shows you how that can be done and what the numbers are that is involved. So I just wanted to show you this and clarify why mortgage price is a little bit more detailed than you might think. But I think this could be helpful to you. Either if you're contemplating getting a mortgage on a purchase and maybe looking to buy down the rate, gives you an idea what the costs are to buy down that rate permanently, as well as how can you extract some net premium from the lender to pay your closing costs if you bump that rate up. So that's your mortgage price seminar, if you will. Hopefully that's clear. If you have any follow-up questions, feel free to reach out to us, submit a question. I'll be happy to clarify it for you to help you understand this grid better. So with that, I want to go ahead and go into the Q&A session. Have Jeff come back because we do have a couple of questions we want to address.
Yeah, I might have some questions on that chart.
Sure. Yeah.
No, I'm just kidding. But okay. It does make sense. So you're saying the 7.5 is kind of that that's what the rates are. There's no plus, there's no minus. It's just that's the way the rate is.
Yeah, I would argue that in this environment, this has been true for several years now, that typically on purchase loan, actually refi loans too, in general, in a majority of cases, we start off by quoting the lowest 0 point rate
Mm.
possible to the borrower. That includes our compensation from the lender. So in that sense, on that grid, 7.5, I would argue, is essentially more or less the market rate in order to achieve that 0 point goal when you're getting that rate locked in.
And then anything below that rate, you're having to pay a premium to get that. In other words, a buy down. And then above that, you're getting a premium back from the lender or a discount or rebate. Is that right?
That is correct. Yeah.
Great.
When you go lower on the rate, there's going to be points triggered. Those have to be paid in order to get that rate. That's essentially the definition of a rate buy down. And
And I
if you
like,
want to go the other direction and raise the rate, you're essentially getting lender dollars from the lender because that higher rate is above market. The lender gives you back some of the value for that. And then you can apply that towards your third party costs, whether frankly it's a purchase or a refi.
Interesting. Interesting. Well, we have kind of a similar question, but it kind of feeds into this is like, just recently, and I've received it in the mail, you might have received it in the mail, and we've seen these things about, buy now. And it kind of like, hey, you've been talking about this for quite some time, and Dave Ramsey is pushing it as, hey, buy now, lock in the price, and then refinance later. But recently I've seen this thing as like, buy now, refinance later at no cost. So with that, it mentions experts saying that you're, buying a home now and refinance later on a cost. Is that even possible? And how does that work, Art?
Well, it's possible, but I think and this is an issue that really kind of gets me going. It's a marketing ploy. Um, there really is technically no such thing as a free refi, but yet it is a very common, if not the most common, way to market mortgage loans, particularly in a refinance environment, which of course we're not in right now. But overall, let me get into what all that really means. And in fact, I even kind of got on the news feed and tried to, get some information on this idea that's floating around and trending. And there was an article from entrepreneur.com that discusses this in detail about, go ahead and buy the house now, take today's rate, refinance later at no cost. I generally agree with that sentiment, as everyone who's been watching this program knows. I think you're better served to buy now if you can, and then take advantage of that one option bet to refinance into a lower rate later. But to suggest that you're going to be able to refi at no cost is technically not true. Why is that? Well, I would refer you back to our previous rate grid on the previous slide, where I gave you that grid of rates from 7 to 8%. The way a no-cost refi is marketed, what it's really saying to the borrower is, hey, look, we'll arrange a refinance for you. And we're going to arrange a refinance for you at a rate where there's not going to be any points charged to you. But in addition, there's going to be that additional lender premium that's going to be created. And that mortgage originator is going to apply that premium to cover your third-party costs. So that means you don't have to pay them out of pocket. And that means you also don't pay them out of your new loan amount, which essentially means you're paying those closing costs out of taking a piece of equity out of your home because of the slightly higher loan amount. Now, as we've talked about before, most refis for conforming loan amounts, the cost these days, the one-time non-recurring costs, are really not that substantial. In a lot of cases, it's maybe $3,000 plus or minus. For larger loan amounts, maybe a little bit more, might go up to about $4,000. So the idea, though, is that those costs are real. They're present. All the other parties involved in getting your loan, whether a purchase or a refi, in this case, we're talking about refis, they still perform a service and they're going to have to get paid. The appraiser, the credit report company, the escrow fee, the title fee, a third-party vendor used to verify your employment. All of those third parties are still going to be charging fees, and they're going to have to be paid. So it's a question of how do you pay them. So the message about buy now and refinance later, I wouldn't say at no cost. It's refinance later, and then we'll talk about how to finance those costs. That can include, financing them in the higher rate. I prefer finance it into your loan amount, thereby your equity, if there's room in your equity to do so, in which most cases there are. Or the third option, you pay them out of pocket, but that's pretty rare. Most borrowers don't want to do that. My problem with offering the no-cost refi, quote unquote, is that you're right going into that refi, you're going to end up getting a rate above that current market. And so understand that by doing that, you're ending up incurring a higher rate and therefore a higher APR than if you chose to refi and finance those costs out of your loan amount, which really means out of your equity. That's going to give you a lower rate starting off with that new refi, and it's going to give you a lower APR. So from that perspective, I think, yes, the message about buy now, refinance later, take that one option bet, great message. I agree with it. I just hesitate to suggest to you that when you do that, you should get or that you should expect a no-cost refi, or that you should even pursue that now that you understand how that really works and what it really means. I just don't think the best execution is financing your closing costs on a refi out of your rate. I think it's always better to finance your closing costs out of the loan amount, meaning out of your equity. That's going to give you a lower rate and a lower APR.
With that thought process in mind, does this whole no cost refi, does it benefit the mortgage broker more than the borrower? And if so, why is that?
Really good question, and that really gets to the crux of this, mortgage industry marketing ploy. And again, it's very, prevalent when we're in a trending lower interest rate market, which of course we haven't been in some time. One of the things you may notice as a sort of what has squirted out of that is you're not hearing a lot of mortgage ads on the TV or radio, advertising refinancing at some particular rate where you can get that refi done at no cost. That refinance mortgage advertising and marketing messages are, rare right now because rates have not supported a lot of refi activity. But the underlying basis of marketing refis to mortgage borrowers as no cost, I argue, benefits the mortgage originator, the mortgage broker, more than the borrower. Now, why would I say that? Well, what happens is when you take a refi and you choose to select a above market rate because you want to absorb or finance your third party closing costs through that rate, again, you're getting that refi at an above market meaning above a 0-point rate. And so what that does is if you go ahead and close that way, it's setting you up for the originator to come back to you and urge you to refi again, even with a very modest improvement in mortgage rates after you've done that initial refi. Back in the days when we had some trending of rates going lower, and there was a lot of refinance activity, I've heard stories where mortgage originators who like to use the no cost refi strategy would go back to homeowners literally 6 months later and say, hey, look, the no cost rate is now 7.25%, even though we closed you at 7.5% no cost. I know it's only a 0.25% improvement, but why not do it again? It's no cost. And believe it or not, they would talk homeowners into doing that. Well, if you think about it, who's really benefiting from that? Well, it's the originator, because they're generating more income by doing that refi potentially several times over a relatively short period of time, because they're selling the borrower on. It's not costing you anything. So a 0.25% improvement in rate is enough to justify the refi. And then if after you do that second refi, rates go down another 1/4 or 3/8, they'll come back to you again. Hey, let's refi again. It's still no cost, and now I can get you another 1/4, another 3/8 off. In the industry, we call that churning, and there's actually some restrictions on doing that. And originators have to be careful when they're delivering loans to lenders to not appear to be, focusing on that too much, because what it does is it creates an acceleration of early payoffs of these loans, which can cause some real problems in the secondary marketing part of the industry. In my opinion, you're much better off take that refi at a 0-point rate, finance the cost into your loan amount, meaning into your equity. That's going to give you a lower rate in APR starting out, and it's going to give you more time before you even need to look at a refi later. In other words, rates would have to improve even more in order for you to really take advantage of a beneficial refi. But you've already started off better to start with over that no cost option. So I think in that regard, you're the one who's benefiting the most, and you're not enriching a mortgage originator who wants to come back to you every 6 months and keep urging you to refi and refi again.
Well, that's a great point. And I've heard of those stories for sure. And it reminds me of someone trading their car in, they finance for 4 years, but every 2 years they trade it in and it's no money out of pocket. But that negative equity in that car is rolled into the new one to the point where they get to that point where they can't get out of it.
Right.
Or they have to live, come with a lot of cash. It sounds something similar to that because you're rolling in those costs every time, although they not, in relationship to size alone, not as much.
That's true. And what's kind of funny about it is I've encountered a few borrowers who've come to me for a refi and insisted that I arrange a no-cost refi. And I went ahead and agreed to it after having a healthy debate, friendly debate about it. But in a lot of cases, what kind of makes me scratch my head is sometimes these are situations where the property value is such that it's maybe, it could be $600,000, $700,000, $800,000 value, and they're getting maybe a $300,000 or $400,000 loan, and the non-recurring closing costs are $3,000. It's like, absorbing that $3,000 in your loan amount in order to get a lower rate and APR in the new refi has got a very limited effect on your overall equity. An accountant would say it's non-material. I mean, it's not a very big hit to your equity. And in return, you're starting off with a lower rate, meaning lower payment, and a lower APR. Why wouldn't you do that over this this no cost nonsense? Where if you do that, then guess what? Be on the watch out. We get another 3/8 improvement in rates. That mortgage originator is going to come right back to you and say, let's do it again. And but again, that's benefiting the originator, the broker, more than the borrower.
Wow. Well, thanks for clearing that up and addressing these couple of questions that our audience had. And I'm going to turn it back over to you for the remainder of the show. So here you go.
Okay. All right. Well, with that, we're going to go ahead and go into next week's closing question. And I'm actually kind of living this right now on a purchase transaction that we have in process. But it's a common question that I run into from time to time. So I thought it'd be a good one to talk about for next week. Here's the question. We're in escrow to purchase a home, and the appraisal report came in low. Do we have to accept the report, or do we have any recourse, such as requesting another appraisal? Very interesting question. Definitely got some information for you on that. So stay tuned next week for the answer to that question. It'll be on the house. And with that, Jeff, back to you.
Yeah, what a great show. It's fun to have some really good news and also to clarify these points. I guess in my head with this last segment you talked about is like, well, to the borrower, isn't each one a no cost out of pocket because you're refinancing the costs into, taking part of equity and refinancing it in versus raising the rate? Aren't they both kind of no money out of pocket?
Well, they are. Again, and in fact, that's the key is that, I can't remember the last time I arranged a refi for someone where they said, I mean, I've run into this a couple of times, very rare, where they'll say, oh, I don't want to refinance I don't want to finance my closing costs into the rate, and I don't want to finance them into my new loan amount. I want to pay them in cash. In other words, I want to bring, essentially a check to escrow for the amount of the non-recurring costs and close the loan that way. Why would they do that? Well, because they think it's better to have that slightly lower loan amount of, say, $3,000, $3,500. If they've got the cash, they'd rather just provide the cash. So that way the new refi doesn't have a higher rate for over 0-point loan, and it doesn't have a higher loan amount because you're financing it into the loan amount. You're just paying it out of pocket. So rarely some homeowners will think that's a better idea and they'll just provide the money at closing. But that's very, very rare. Doesn't happen very often.
Wow. Well, thank you for clearing that up and being the expert on the line, because that when you were talking about that rate chart, when I was putting that together, I'm like, I have no idea what all this means. So now I have a much better understanding. And I think I could actually share that with my wife and have her understand what we're talking about there. So thank you.
Well, or she'll help you understand.
There you go. That's probably the better way to go.
Right,
Hey,
right.
if you have more information or if you have more questions for Art, you can reach him at the information online or on the screen. It's 760-883-5700, or you can call him on his cell phone. Yes, he does take that in a pool. It's a watertight case. He will answer your phone because I'm not sure. Do you have watertight earbuds as well?
I do not.
Okay, well, maybe that's on the next show.
All right.
714-612-9035. And you can call him on his cell phone. And of course, you can go to the website and check those rates because at this point, as you saw in the chart below, it's the kind of chart we want to see. It's going down significantly at mwloan.com. And of course, drop Art an email at art@mwloan.com. Art, any last bits of information before we sign off today?
Couple things, Jeff, actually. Number one, I want to point out to somebody in terms of rates and what the Fed funds rate has been doing. If you think about it, it's been on a pause now since July.
Mm.
So what does that mean as it relates to certain loan programs? I'll bring up, as we talk about a lot, HELOCs. HELOCs are tied to the prime rate. The prime rate is directly correlated to the Fed funds rate. What that means is we have seen essentially no increases in HELOC rates since July. And I think and given that the markets are now embracing the idea that the Fed very well may be done raising the Fed funds rate, what that establishes is that HELOC rates, I think, really have hit a plateau. And so for those homeowners who are still on the fence about getting a HELOC, and they're worried that because it is a variable rate loan, that if you get one now, you're going to ride up even higher in rates after you get that loan, I would argue timing is good right now where that's unlikely to happen, or at least the probabilities are much, much less. So if you are trying to time the market, which I say not to do, but to the extent you're thinking about that, looking at a HELOC now, if you really are interested, it could be a great time because I think you can end up getting a rate that could prove to be your ceiling for the foreseeable future. And you should be able to see that ride down once rates do start to fall, which is becoming sort of there's a higher expectation of that than there was just a week or two ago. And then the other thing I want to point out is some good news in terms of our program the next couple of weeks. We're going to have a couple of guest speakers next week. In fact, we're going to have a realtor. Her name is Brenda Devlin. She's a realtor here in the Coachella Valley. And we're going to have a little session where we're going to talk about interest rate buy downs, particularly temporary buy downs, and how they can help in terms of getting more homes bought and sold. Then the week after that, we're going to be talking to someone about credit scores and credit score improvement and credit score education. And then the week after that, we'll be talking to someone. We expect to have someone here to talk about getting a solar system and what's the best way to finance those. So that's coming up in the next few weeks.
It's exciting stuff. Exciting stuff. I can't wait to dive into that and have an opportunity to hear what they have to say. And really, the one thing I'm looking forward to is next week, particularly because of so many agents out there are saying, "Hey, things are slow," and you have been really singing this song for a while of like, if you would use this tool, you could really probably sell more homes. So I'm excited to hear about that.
Yeah, it should be a good session.
All right. Well, have a great week, and I'm bowing out. I'm checking the comments, and we'll see you next week.
Okay. Thanks, Jeff. Thank you, everyone, for watching and listening. My name is Art Alvarez with MortgageWorks, where we do have the answers, and they're on the house. We'll look forward to seeing you next week. So long. Take care.